Hello and welcome back, guys. So in this particular session, what we will be covering is TYU number 3 associates. Let's look at the question first of all. So the summarized statement of financial position of Backup, Townley and Richworth as at 31st March 20x7 are as follows. So PP is given, development expenditure has been given, investment has been given. Okay. In the next page, okay, so I'll need to get another page as well. So, okay, so our additional information is over here. So I'll just download the other page. Okay, so what we've been given is that. So we've been given this inventory, receivable, cash at bank, and then total assets, equity, 25 cents of shares, share premium, return earning as at 31st March, and then return earning for the year. Sorry. So we do have current liabilities as well, such as trade payables, bank overdraft, taxation. So, and then what we are also given is that Backup acquired 16 million shares in Townley on 1st April 20x6, paying 75 cents per share. Okay. On 1st October 20x6, Backup acquired 40% of the share capital of Richworth for 400,000. So for the year ended 30th April 20x7, I guess it's x7, 20x7, yeah, 31st March 20x7, and then we acquired subsidiary 1 year ago, and then in case of associate we acquired it on October. So this is a mid-year acquisition. Okay, so it should be time proportionate. So let's do our group structure or standard format. Working note 1, bold. So what is this again? Group structure. Always group structure over here. And then for subsidiary, parent, non-controlling interest. So how much do the parents have? So 1600, right? So that's what it said in the question, I guess. So yeah, 16 million shares out of 500. How could that be? 25 cents. So what we need to do is that. So since it is 25 cents, so there must be 500 divided by 0.25 numbers of total shares. Okay. So the parents holding will be 1600 divided by 2000. Okay, so 80% is the parents holding, and non-controlling interest will be 20%. Okay, so what's the holding percentage? 40% for associate. 40%. So what I will do is that I'll make it a percentage column, and then after that we'll calculate the working note 2, which is calculation of net assets, right? So calculation of net assets, calculation of net assets of subsidiary, and then at acquisition, at reporting, share capital, we have a share premium as well, share premium, retained earning, And then anything else, let's look at it. So share capital, let's record that first. So share capital is 500, right? Share premium 125. So 500, and then same figure over here as well. How much was the share premium again? 125. 125. So same figure over here, and then retained earning. So we've been given retained earning as at 31st March 20x 380 and then 400. So we should add this two up for reporting period. Okay. So what will be is that 380, and then this is 400 for the year, and then for earlier year it is 380. So our total is 780. Okay. So let's look at if there has been any fair value adjustments or not. So it does not say anything about fair value adjustment over here, whereas in this particular picture, does it say, talks about development expenditure and then inter transactions and then fair value of non-controlling interest. Okay, so there is no fair value adjustment, but in case of intragroup transaction, has there been the inventory of backup includes goods as a transfer price of 200,000 purchased from Townley. Okay, so Townley is our subsidiary. So we have purchased from subsidiary. So, and then all transfers were at cost plus 25%. Okay, so we do have a PURP. So what we will do is that copy. So we'll leave few space, and then this will be for our working note 3. This will be calculation of goodwill. Of investment. Let's make the pro forma quickly. Fair value of NCI, and then less net assets at acquisition. Acquisition, and then this will be our total goodwill, and then if there has been any impairment, that will be over there. That space should be enough, and then this will be our NCI, and then after that working note 5. So working note 5 should be a bit bigger, and then after that investment, and then that should be a bit bigger as well, and then after that we have PURP for subsidiary, and then PURP for another thing. Okay, so this will be 7, working note 7, calculation of so what we need to find out is PURP of subsidiary, right? So cost, selling price, and then goods, total goods, and then so let's look at it. Intragroup transactions. So 200,000 was sold, purchased from Townley, and then inventory of Richworth includes goods at a transfer price of 125,000 purchased from backup. Okay, so that was sold by parent. So that means 200,000, and then all transfers were at a cost plus 125. So that's 125% is okay. So 200,000, right? So what I will do is that figures in thousands, and then so since this is 125% is divided by 125 will give us one's value, 1 unit, and then after that 100 will be our cost, right? So that's our PURP, or I mean cost, right? and then the net profit which has been unrealized is this minus this 40,000. So PURP and be bold, and then C65, C65. So less PURP and then minus C65, right? So that's done as well. And then is there any fair value adjustment? No, there is not fair value adjustment. But what about this development expenditure? So the development expenditure in the statement of financial position of Townley. Okay, so it's of Townley is to be written off as incurred as it does not meet the criteria for capitalization in IS 38. Okay, so capitalization criteria in 38. What are they? You can comment down below. So capitalization thing is not met, which is basically the criteria are is that it is technically feasible, it is likely that a commercial production will happen, and then it is probable that it will be completed within short period of time. Okay, so those are the criteria which haven't been met, so it is expensed. So it commenced on 1st April 2006. Okay, at the date of acquisition, the date of the capitalized expenditure was 80. So no development expenditure of Townley has yet been amortized. Okay, nothing has been amortized because it's not yet ready. So when will we amortize it? When it is ready. So since it is not yet ready and then it does not meet the criteria for capitalization, so it needs to be written off, right? So its value at acquisition was 80,000, and then what about its present value? So development expenditure was 200. Okay, so earlier on it was capitalized by 80, and then now it should be deducted by minus 200. Okay, so less development expenditure because it reduces our net assets, right? Because we had capitalized it, so now it's not an asset, it does not qualify as being capitalized, or it does not qualify for capitalization. Okay, so what we'll do is that sum it up. I guess we have covered everything. So in case of goodwill, what is the cost of investment? So paying 75 cents per share, right? So 75 cents, so 1600 into 0.75. 1200 was the amount that we paid, right? And then fair value of NCI is, it's over here, 95. So this plus this, and then after that net assets is minus, or net assets is minus this figure, right? And then total goodwill. Has there been any impairment in goodwill? Need to look at that very carefully as well, otherwise the trouble. So no goodwill impairment, no, nothing has been there. So this is just about cash in transit, I guess. Yep, due to cash payment of it this much. Okay, so cash in development expenditure has been solved. So in case of investment for associate. Okay, so what we need to do is that fair value of NCI. Let's calculate NCI. So NCI is 95, share of post acquisition profit, right? So how much is the post acquisition profit? Is this minus this into what's the holding percentage of NCI? 20%, right? So that's there, and then after that has subsidiary sold to thing that's already been adjusted. Okay, PURP has already been adjusted. Anything else? I don't think so. So what we'll do is that leave one gap. If there is anything missing, we can add it up. This. Okay, so our total NCI is this figure. And group reserves, what about group reserves? 100% of parent, right? So how much is the retained earning of parent? So it's 2300, right? And then there is another one more, 1760 for the year. 2300 and 1760. 2300 plus 1760. And then what is it getting? Post acquisition profit. Post acquisition profit subsidiary. Okay, post acquisition profit subsidiary. So we'll just merge it so that it just looks good. Post acquisition profit of subsidiary, and then there will be a post acquisition profit of associate as well. Associate, and then what the post acquisition profit of subsidiary is, this minus this into parents holding, right? 80%. And then associate. So in case of associate, what has happened is that how much is our profit, post acquisition profit. So has it been given? Yes, retained earning for the year 150. So it's acquired on 1st October 20x6. So October, November, December, January, February, March, 6 months, right? So 150 into 6 divided by 12. 150 into 6 divided by 12. 75, right? So in case of parent, is there any impairment of goodwill? Impairment of goodwill. Or is there any PURP? So goodwill is 0 and then PURP. I think there is, because I guess who was the seller in case of associate? Let's look at that question again. So the inventory of Richworth includes goods at a transfer price of 125,000 purchased from backup, right? So 125,000 worth is still there. So what we will do is that we'll just ignore it right now, and then we will create another working note 8. Let's put the values and then we'll get our PURPs. So how much was the selling price? So selling price was 125. So markup is 125, and then this is 125%, which is 125 into 100, right? So our PURP is 25, right? But PURP of parent at the rate 40%, because we only hold 40% of that, right? Minus this value into what's our percentage holding percentage 40. Okay, so that's our PURP. Anything we have left out? I guess not. Goodwill hasn't been impaired, so no impairment. PURP in case of thingy, subsidiaries case is already been adjusted. In case of parent as well, it's just been adjusted. And then after that, this is our total reserves. I'm just leaving one space for if I have missed anything. So it's so many things to remember, sometimes you might forget as well. So 4317, cost of investment, and then share of profit, cost of investment. How much did we pay for this? 400 for our associate. 400. What's our share of profit? How much profit did we make? 150, right? 150, and then that was for 6 by 12, right? So 150 into 6 divided by 12. So see, this figure and this figure should be same. Or what I will do is that copy paste this particular thing. So yes, has there been any impairment of investment? We don't know that yet. Is there any PURP? If parent is seller, and then anything else? Impairment of investment. Let's read it. So there hasn't been any impairment, I guess, in this case. No. So impairment is 0. PURP if parent is the seller, yes it is, and then it will be same figure as in group reserves. Okay, so see how like uh, your equity is equals to assets minus liabilities, right? So basically what should happen is that, so left hand side when it is being reduced by 10, the right hand should also be reduced by 10, right? So see how the profit is 75 and then 75 over here as well, it's same, so it should be same figure. Okay, so PURP will be is equals to this figure into our percentage holding, so 40. So we'll have to should be in minus, and then that's our total investment. So I'll just leave a gap and then put up a formula. So 57. Okay, so that's done, and then anything else that we are missing out? So let's check out one thing. So 450 and this 600. Okay, so I'm just checking out that thing as well. So it's always good to check out. What I will do is that copy and then paste it over here. So it's always good to check out the associates net assets as well. Okay, so that you know what's happening inside it as well. So this is 200 and 450. 200 and share premium is 0. 450 is this, and then development expenditure is not there, this is not there, and then this is not there, and then so what's our closing retained earning? So see, a exact figure hasn't been given, so it's 450 until the year beginning or opening balance, and then the retained earning for the year is 150. So it should be this earlier plus 150, so 600. Okay, so our differential amount is this minus this 150. Okay, so sometimes there might have been any adjustments or anything short, and then that might change our this values. Okay, because this figure might be different. So we might assume that the profit is 150, whereas in this case sometimes, suppose if let's say the retained earning is only like let's say 500. So see how this value changes, and then our whole calculations will be wrong. Okay, so 600, right? So what I will do is that it's always good to do it this way. So what I will do is that this minus this, and then That's how we get our investment. Okay, so in case of this as well, we'll do the same thing. So this minus this. Okay, so that's been done. So in this case, you can also write post acquisition. So this will be this figure minus these are the differentials. Okay, so rather than having to do all those procedures down below, you could just multiply it with 150 so that you get your profit. Okay, so that's pretty much it. Let's prepare our consolidated financial statements. Consolidated SOFP financial position, I mean, on current assets. It's from working mode 2. So this is 370. And then what else do we have? This one PP 38204425 38204425 38204425 property plant and so investment. So one thing else, another thing that's very important is that when you write investment, just write the full amount and then start deducting from there. So 1600 minus how much did we invest? So 400 in associate and then 1200 in subsidiary, right? So that's our zero value. So sometimes if the investment in associates and subsidiary is less, or like they might have made a investment in something else, right? So that value might be missing. So it's always good to write investment as well so that we don't miss out, you know. So investment in associate is this figure, and then this is our total. Let's keep one gap. So even in exam session as well, it's always good to keep a gap so that, you know, who might miss something because there is so many things to be remembered. So current assets B, and then after that, what do we have in current assets? So inventory, receivable, and cash at bank. Inventory, receivables, cash at bank. Okay, so in case of inventory, what we shall do is that 270 1280 2740 plus 1280 1280 plus, is there any PURP? Yes, there is one PURP which is sold by the parent, and then anything else? Since we are not consolidating, okay, so that's it pretty much. So even though parent has sold it, we don't need to adjust for parent because we are not consolidating for associate. Okay, so in case of receivable, what has happened is that, let's look at this question. So this was about uh, selling price and all, and then after that the receivable of backup include an amount owing from Townley of 250,000. Okay, so 250,000 is owed, and then this does not agree with the corresponding amount in the books of Townley due to cash payment of 50,000. Okay, so it has made a payment of 50,000. Okay, So 50,000 has already been paid. So that means our receivable will be reduced by 1960 and 980. 1960 plus 980 minus 200 minus 50. You know why I did that? Because it's cash in transit, as you can see over here. So the 250,000 one company owed to other, but the balance do not agree. That means 50,000 is a cash in transit. Okay, so it has not been received by backup, so it's a cash in transit. So in that case, what we will do is that we will assume that the cash is in bank, so we'll add it in bank. Okay, so 1260 plus 50. Okay, so that's there, and then after that, total. So just leave a line, total current assets, bold this thing as well, and then sum, and then this should give us out total assets, which is else but this plus this figure, right? So 1760, let's look at it. So highlight it as well, and then in case of equity, so what do we have in equity? Share capital, share premium, and then what else do we have? Group reserves. So in this case, this has been derived from working note 6, right? And then investment is not there. PP has been adjusted from working note 2, and then inventory, sorry, PURP. So inventory has been adjusted from working note 7, and then receivable has been adjusted as well, and then cash at bank has been adjusted as well, and then share capital. Let's look at our share capital. So let's see something. This has already been recorded. Does it say that the transaction has not been recorded? If it is not recorded, then we need to add the share capital of the other company as well, whereas in this case it does not say anything of that sort. Okay, so that means 4,000 is equals to 4,000, and then share premium 800. So remember one thing, that even though if it had not recorded, see like how our ordinary shares is 25, and then the particular buying company for the subsidiary is paying 75 cents, so 0.75 cents it's paying extra, so that should have been in our amount in share premium. Okay, so since it's already been recorded, that's why it's already over here. Otherwise, like we would have to record it. Okay, so always remember, like if there has been uh, per share payment which is higher than the nominal value, then the rest of the value should, or the value should be split between shares and share premium. Okay, so in case of retained earning, so what we will do is that bring the group reserves from above, working note 5. So what's our group reserves? Okay, so our group reserves is 4317, and then what about our NCI? So what you could do is that total equity, and then total equity, bold it, sum, figure, and then after that NCI. Our NCI is this figure 143 from working note 4. Note 4, okay. And then current liabilities. So current liabilities, trade payables, bank overdraft, taxation, right? So current liabilities, CL, bold, and then trade payables was the other thing, bank overdraft, and then taxation. Overdraft, taxation, right? So trade payables is, how much is our trade payables? 2120 plus 3070, 2120 plus 3070 minus, so there has been a mutual owing as well. So see how it says, like the payables, if the receivables of backup has a amount of this figure, then there should be a corresponding amount of same amount of payables as well, right, in payable side of whoever is the selling company, right? So it is a transaction between subsidiary and parent, so there should be a, a payable and a receivable in the other party's financial statement. Okay, so since 250,000 does not agree with the figure, so that means the payable has already been reduced by 50,000 due to cash payment. Okay, so minus 200. Okay, so remember how we changed the receivable as well by 200, and then the 50 was we subtracted from here, but we added it over here. Okay, so it's not now a receivable because the cash is already on its way, it's a cash in transit, right? That's why we added it over here in cash, so it's removed from receivables. Okay, so in case of bank overdraft, did we subtract it though? I was busy explaining. Yes, we did. What's the bank overdraft? So 2260, 2260 only for the subsidiary, not for the parent. Taxation is 400 and 150. 400 plus 150. So our total current liabilities is sum of all this figure. Hold total equity and liabilities is control B, so that's this current liabilities figure plus our non-controlling interest and then plus equity. Okay, so the figure matches. That's always happy, isn't it, when it matches at the very end? Okay, so see, even though like it's always good to leave few spaces. Okay, so see, I have left few spaces over here as well, so that sometimes you might miss something. So it's always good to leave a space so that we can fill it up. Otherwise we have to drag all this thing down, copy and paste, and then if we have linked it, sometimes it might be messed up. So you don't remember what has been linked with what, so it's kind of a bit complicated, it gets in the way, and then so it's just better to do it that way. And then in case of net assets, in case of associates, you can make this sort of calculations at the side as well. Okay, so that's pretty much it, guys. So TYU 3 is done. If you have any other questions, please do comment down below. I'll definitely answer it for you. So this particular TYU is finished. So we'll look at another TYU where we will be discussing about how to account for dividends, and then after that we will also discuss some multiple choice questions, and then we'll wrap up with associates problems. Okay, so that's it for today, guys. See you next time. Bye bye.